Hello Rogers TV, welcome to Smart Money, the show where we teach you how to make the best use of your money to reach your goals in the most efficient way possible. Consider me your financial GPS. I'm your host, Mitchell Huynh. This week, we look at the basics of financial planning. How do you achieve your financial independence and other goals along the way? Most people think financial planning is putting aside a couple hundred of dollars every month into their RRSPs and TFSAs. Although it's good to put aside money, this in itself is not a plan. A plan involves specific goals and milestones, quite similar to a business plan or roadmap. You need to know what you want and save towards that goal. A strong financial plan is built on 4 cornerstones. Short-term reserves, which protect you over a period of a few months. Moderate-term goals, any goals within a 7-year timeline, such as purchasing a home, an expensive vacation, or your children's education. Longer-term goals, any goals 7 years or longer from today, such as retirement. And lastly, but most importantly, income and asset protection, which protects your moderate and long-term goals in case of premature death, disability, or critical illness. For today's example, we will put together a simple financial plan with the long-term goal of retirement. Questions we need to answer are: how much money do you need to retire comfortably? How much money do you need to invest to get there? How is this going to affect your current lifestyle? These are all questions we will answer today, so tune in as we explore the world of financial planning. For the purpose of demonstration, let's say your only goal is to retire in 15 years from today. Our first step would be to put together a snapshot of your current financial situation. For example, let's pretend you are 35 years old, which means you want to retire at age 50, 15 years from today. Currently, you have 3 assets: a small condo valued at $300,000, a car valued at $25,000, and $10,000 cash in your bank account. You owe $250,000 on the mortgage and $10,000 on the car. From this, we can put together a balance sheet. You can follow along and make one of your own. Under assets, we have the condo at $300,000, the car at $25,000, and $10,000 in cash in your bank account. Under liabilities, which means the amounts that you owe, we have the mortgage at $250,000 and the car loan at $10,000. This gives us a net worth, which is all of your assets minus your liabilities, of $75,000. Great start. Now, we need to move on to your cash flow. Simply put, this is all the money that's coming in minus all the money that is going out. You currently make a salary of $60,000. Assuming you live in Ontario, we can assume that after taxes you will make around $45,000 a year. This means that monthly you will make $3,750 net, or after tax. Let's assume your monthly expenses consist of spending $400 a month on housing. This includes maintenance fees, utilities, etc. $325 a month on food, $400 on transportation, which is gas, car insurance, maintenance, $200 on entertainment, and $100 a month on personal things, such as clothes, hobbies. Let's not forget the mortgage and the car loan, which is a monthly payment of $775 and $250 respectively. From this, we can see our total expenses for the month are about $2,450. We make net after taxes $3,750 per month. This gives us a grand total of $1,300 free cash flow. That's money that is currently not being used. Now, since our only goal is retirement, we need to estimate how much money we will need in retirement. Let's say we would be comfortable with an income of $40,000 a year, which would give us $3,333 monthly income. By the time we retire, our mortgage and car loans should be paid off, and other unnecessary expenses will be kept at a minimum, so that we are able to travel a bit every year, spend time with family, and basically enjoy a stress-free life. Let's also assume that we will receive a modest yearly pension from work of 4% of our final year's salary indexed to inflation. With this goal in mind, let's put together a savings strategy. We have two items we need to tackle. Firstly, a short-term reserve account. The $10,000 cash we have in our bank account, $7,500 of that we will allocate to an emergency account. This account is the short-term reserve we spoke of in the 4 cornerstones of financial planning. This represents 3 months of expenses. Remember, from our cash flow, our monthly expenses totaled about $2,350. This account will be used for emergencies, such as short-term leave from work or being laid off from work. This covers us in case we lose our source of income and allows us 3 months to recover. Since we have already budgeted for all of our expenses, including entertainment, let's say we are saving $1,200 of the $1,300 free cash flow every month. This leaves us with $100 for other expenses we may have missed. Our retirement savings we're going to split between our TFSAs and our RRSPs. Since we haven't done anything with either account, we will prioritize the TFSA, which is a tax-free savings account, over the RRSP account. In general, when you withdraw money from a TFSA, it is tax-free. When you withdraw money from an RRSP, the government taxes the withdrawal as income. So the amount in your RRSP is not the amount you will receive. The advantage of the RRSP is that any deposit you make, you will receive a tax rebate on after you do your taxes at the end of the year. However, the main goal of prioritizing the TFSA is to receive as much tax-free income during retirement as possible. This will allow us to maximize all the government benefits such as CPP, which is Canadian Pension Plan, and OAS, Old Age Security. More on this in our later episodes. Of the $1,200 each month we will be saving, $800 will be placed in our TFSAs and $400 into our RRSPs. Since we are looking to retire in 15 years and currently have no retirement savings, we will invest in mutual funds to achieve a modest return of 6.5% annually. Any other non-market asset classes such as GICs and bonds offer returns that are too low to achieve our goals. Using the future value formula and Excel, we determined that in 15 years at a growth rate of 6.5% annually, we will have a grand total of $532,000. While this sounds like a lot of money, we will run out of money well before we die at the age of 90. At this point, we have 3 options. First, retire later. Second, save more. Third, live a simpler lifestyle in retirement, which means, for example, rather than having an income of $40,000 in retirement, maybe an income of $34,000 would work better, which is $500 less every month. Let's say option 3 is out of the question. We don't want a reduced income during our retirement because we want to enjoy life. That means we can either retire later, which was option 1, or save more, which was option 2, or a combination of both. Let's do both, as we currently are only saving $1,200 of our $1,300 free cash flow, meaning we have $100 a month surplus. Let's put the whole $100 into our RRSPs every month, and let's change our retirement age from 50 to 59. By saving a bit more every month and working for a few years longer, we are able to amass a grand total of approximately $837,000 versus the $530,000, allowing us to have a comfortable retirement with a yearly income of $40,000 a year. And that is a quick and easy financial plan. As you can see, even with a simple plan, there are many things to consider. I hope that this gives you a clearer idea of how to strategize for your financial future. If you have any questions in regards to your personal financial plan, don't hesitate to contact me. So now that you know how to financially plan for your future goals, whether it is just retirement or the additional goals of buying a home, putting your kids through school, etc., what else is there? Like with any plan, the plan is only as good as the execution. And the execution of the plan is only as good as how well you plan for contingencies. All plans look good on paper, but what happens if things don't go according to plan? First, let's define wealthy. as this is a goal most people have for their retirement. Although most people have a different number which defines wealthy, the most simple definition would be waking up one morning and deciding not to go to work ever again and not having to worry about money. Unless you're one of the lucky few who were born into a rich family or won the lottery, most likely becoming wealthy will take continual savings and investing. In the inverted triangle of wealth, looks something like this here, we all start near the bottom. We've graduated from college or university or just immigrated, and now we are working, saving, and investing our money. We continue working and saving and investing, moving up the triangle step by step. And eventually, if we do it correctly and according to the plan we've built, we become wealthy and retire comfortably. When we build a financial plan, we want to protect your greatest asset. Most people, when they think about their greatest asset, they would think about their home, their car, or even their spouse or children. All of these are assets. However, none of these are your greatest asset. Your greatest asset is your ability to pay for and maintain your home, your car, and your family. Your greatest asset is your ability to work. By generating an income, you can now afford your home, your car, and provide for your children. It also gives you the ability to save and invest for retirement. If your annual salary is $60,000 a year and your work life is 25 years, that means your ability to work is worth at least $1.5 million. So what happens if you can no longer work? Regardless of where you are in the wealth triangle, you will start drawing down on your savings to support your lifestyle. If this continues, after a period of time, you will deplete your entire savings, moving down the triangle, and possibly even going into debt. When you are able to start working again, you will need to pay back your loans and start saving. This means you will have to work for more years than you've planned to, or retire with much less money, or both. None of these options are ideal. Therefore, no matter how good of a plan we put together, we need to make sure we can guarantee that no matter what happens to you and your family along the way to becoming wealthy, we can still make it there. There are 3 things we need to put into place to crash-proof your financial plan. The first is disability protection. This means that if you get into some sort of accident or get sick, and this develops into a disability that prevents you from doing your job, you will still get paid a large portion of your paycheck every month. Most people think of disability as losing an arm or a leg, but that is not the case. This can be something as simple as stress. Any sort of disability that prevents you from doing your job, prevents you from getting paid, which prevents you from saving and investing, which prevents you from retiring according to plan. By putting disability protection in place, we can ensure that you will always have a regular paycheck no matter what. The second is critical illness protection. I know that if I or if any of my loved ones get a critical illness, I am not going to be at work. I'm going to be at the hospital beside them the whole way. Critical illness protection will pay you or your loved ones a lump sum of money for after 30 days after the diagnosis, which can be used for anything you wish. Most people use it towards medical treatment in the US, as the wait times for treatment are shorter and the treatment is at least the same or possibly better. The last protection we want to put into place is life protection. This will ensure that if anything happens to you before you become wealthy, your family and loved ones will get a lump sum of money. This will ensure that they will have enough money to support and take care of themselves. Just because you've died doesn't mean that your responsibilities and your love to your families have stopped. Think of these 3 protections as safety features of your car. You wouldn't plan on taking your family on a 25-year-long road trip in a car without brakes, airbags, or a steel-reinforced chassis or car body. So likewise, you shouldn't plan yours and your family's financial future without safety features. The costs of the protection are not much and guarantee your plan to becoming wealthy. Depending on how young and healthy you are, all 3 protections may only be $200 a month. That's almost nothing compared to the $1.5 to $2 million, which is how much your ability to earn an income is worth. Make sure you and your loved ones are protected. It will be well worth it. And that wraps us up for this episode. See you next time when we discuss our ESPs, saving for your children's education and home buying. I look forward to all of your email questions. Have a topic or a question you'd like answered on the show? Contact me at any time at mitch@smartmoney.ca. That's mitch@smrtmoney.ca. We'll be back with more Smart Money after the break.